Alright guys, welcome back to You're Not Yield. Hope you're doing great. It's the end of the week and I have a very nice video for you guys because today we will look at 5 reasons why you're currently not profitable in trading.
5 reasons why you are not profitable.
Also why maybe you are still in a gridlock, and I really hope this video will help you to solve this gridlock. I've been trading for 10 years guys.
Not bad, kid.
And I will show you specifically how what I did in my strategy, what kind of measures I took to overcome these reasons and solve these issues. And of course, feel free to copy these ideas if you like. I hope it will help you and propose you to the next level. So without further ado, let's go. Okay guys, so these reasons are also listed in an order that the most important reason why you're failing will come last, to keep it interesting, right? So now the first reason I want to list, but like I said, the most important one will come in the end. The first reason is basically you see the term strategy as a holy grail.
Reason 1, strategy hopping.
Right? Basically, you think the trading strategy is the holy grail and you need to have a strategy that is very, very good, and only then you can become profitable. So this is the first reason why you fail, because actually that is kind of clouding your judgment. It's this thing that is in front of you and it doesn't let you see the truth, because the truth is that it doesn't matter what your strategy is. I said this over and over again in many videos, right guys? So basically it doesn't matter what kind of strategy you have at all, because the strategy itself is just a viewpoint on the market, right? It just is a viewpoint. Okay, I want to do something here, I want to do something there, right? But that's basically it. And this idea that the strategy itself is a holy grail, this is keeping you from getting profitable. And what happens because of this is this term called strategy hopping, right? Many people, they think the strategy is the holy grail, right? They want to look for the perfect strategy, and if they see a strategy is not working, then they hop into the next one. And this is a big factor that keeps you in this downward spiral, and you can never become profitable because you always think the strategy is the issue, when in reality the strategy is not the issue at all. There are many other reasons that why you're failing, and the strategy is not one of them. And unfortunately, a lot of people, they keep being in that strategy hopping cycle and never make it out of that. So that is the first reason. You see the strategy as a holy grail and then you do strategy hopping, and this keeps you from not having success in trading at all. Alright guys, now the second reason. Like I said, this is also not the most important one, but it's definitely one in the top 5. So the next reason is over strategizing.
Reason 2, overcomplicating your trading system.
Okay, you're not keeping your trading simple, right? Let's say you found the strategy you want to stick to. Fine, that's good. Now you have a certain viewpoint on the market, that is well, right? But then the thing that most traders do, they want to add and add and add to the strategy and then make everything overcomplicated, and that is also a recipe to disaster. In my opinion, it doesn't matter what strategy you're using. The most important thing is that it's simple, right? It needs to be very, 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 very simple. And I will show you how I keep it simple in my strategy. Okay guys, and for this we need to take a look at the charts. So let's change here the overview. Perfect. So now we are seeing the charts as well. How did I overcome this problem of, overcomplicating things? So I basically overcame this with starting on bigger time frames, right? So let's do this quickly. You can see the smaller time frame is here on the right, the bigger one is here on the left. So on the left I open the weekly and make this full screen. So basically to overcome it, I dumbed it down a lot. I want to always go with the bigger flow. I want to find the bigger stream in the market. Think about the bigger force, the bigger flow, the stream where it's going. And for that, I look in the weekly, right? And on the weekly, basically, I only look at the current candles, basically, that, a couple of last current candles. I don't even care about the price data in the past, really. And I just try to, analyze or guess what the next kind of weekly candle will be, right? And I showed you this many times. I basically look here for color, green, red, and basically look for thrust, right? What does thrust mean? Basically here you can see it, red to green engulfing, and as long as there's no counter engulfing, which is currently not the case, you can see there's no other candle, we're starting from here, right? And there's no other candle that did a counter engulfing, right? So basically think about it like that. Here you have engulfing, there's a bigger body, so we know we want to go long only. And you know, at that point I keep it very simple, right? I know I want to go long only, and that's basically it already, right? Keeping it simple. And then you can see, now let's look at the next couple of candles. It's you know, going up, and you know, I look at the smaller time frames for entries then, of course, but like you can see, there is currently here no counter engulfing whatsoever. Let's do it like that. And that is basically showing me that this market is still up, right? That's basically how I'm treating it. So making it very dumb, very simple, going to the higher time frame where I can find the big flow, and then I'm looking, is it green or red currently, and I'm trying to predict the next candle, right? And I'm looking, is it in thrust or not, or where is the thrust, right? Because it's always basically in a thrust, but is the thrust up or down? And that's basically it. With that, I can keep it very simple, and then I make my decision. Good, the current week is green. Good, the week is currently thrusting up. There's no counter engulfing. There was engulfing before, so it's thrusting up. So then I know long only for the time being, unless we get a counter signal at some week. Then I'm switching to short, right? But this is very important. You need to have a very, very simple system that will show you, okay, now I'm gonna be long only, or now I'm gonna be short only, right? And this is how I solve the problem of the overcomplicating things. I dumbed it down. I'm looking at the big time frames to find the big flows. That's where I'm getting my edge from. You know, I want to go with the big money, with the big flow, the stronger move, and keep it very simple there, right? That's basically everything already, right? And everything else just builds up on that. But like I said, you need to have this very, very simple first approach in your strategy to, you know, dumb everything down. Because if you make everything complicated with 1,000 indicators, with 1,000 other stuff, then you're just going to be overcomplicated, and that there's no reason to overcomplicate it, because the market is anyway random, right? This is very random what's going to play out here, and you just need to adjust to the randomness. Okay, then let's look at the next step, guys. Okay guys, so what do we have on the list next? So now we're already at the third reason, so we're getting to the more important things why you're currently failing, and here I have over trading, right?
Reason 3. Overtrading, you are not sideline enough.
Right, you don't know when to be sidelined, and you're still over trading a lot and just doing random trades. This is a very, very big problem that everybody is facing, right? I also faced this myself for many years, and actually you also don't know the power of being sidelined, right? Because professional traders, most of the times they're just sidelined. 80% they're just sidelined. We're just watching, observing, and then in the most, you know, high probability quality plays, only there we try to go into the risk. Other than that, we just sideline, right? And for me, even I'm just sideline a couple of weeks, couple of days, and that's totally fine, right? If there's no good signal, no high probability things, I'm just gonna be sidelined for even a week if it has to be. And definitely sometimes I leave out some trading days, because not every trading day is good, right? So this is also a big thing. A lot of people have like this strategy where they want to trade every day, and this is not good, because it leads into over trading, and with that you're gonna be you know, not profitable, because there's a very high correlation between the number of trades and profitability. The higher the number of trades are, the less profitable you're gonna be, the more minus you're gonna have, right? So overtrading is a big one, and now let me show you how did I solve this in my strategy. Let's go back to the overview right here. So as I showed you guys, first of all, what did we do? Let's get the window here. So basically we are on the weekly, we dumped it down a lot. Is it long? Is it short? Currently it's long, so we know our bias, so we only want to trade long. So the next thing we're gonna do, we're gonna go down to the smaller time frame to find better entries, like more precise entries. And let's do this here. So now I have the 4-hour open here, right on the right side. Let's clean it up quickly and let's make it full screen right here. So on weekly, we already know we want to be long, right? So that's already a given. So we decided this back here already and back here. This is basically where the weekly engulfings happen. So now we need to have a system to not trade a lot, right? We just want to be there for the best signals, right? And what I do here is I wait for pullbacks, of course, against the trend. So the trend is currently long, right? We want to do long only, and we want to wait for these kind of pullbacks that you can see here, that you can see here, right, and that you can see here. Okay, these are the kind of pullback areas, right? Normally they come also in 3 kind of waves if you want. And so then we get these cheap prices, and these are fine with the Bollinger Bands, right? So the cheap prices here are basically happening at the Bollinger Bands. These are like the second and the third standard deviation in the Bollinger Bands. Very simple. And these are areas where it is cheap, right? So you can see this here, here, and here. There are cheap areas where you want to take some buys, right? So basically weekly, we know already we want to be long only. And now I hate these drawing tools in trading view. These buttons never work, guys. So, and what is that? Okay, and here you go. So, and basically we just want to go on these kind of opportunities, right, that we can find here. Now guys, you can see that we filtered out these kind of nice signals, right? And I do this on the 4 hour and also on the 2 hours, because sometimes you can also find these prices here on the 2 hour, like right here. And basically there's another one right here, right? I don't know why this trading view is always showing up this new option here. I don't like it, but okay, it is what it is. And anyway, you can see that currently there is another good opportunity in EURUSD right here. Also, again, on the 2 hour, second and third standard deviation. This is why I bought it here as well, right? I'm expecting actually this high point to come in longer run. But anyway, as you can see, this is how I filter out signals, and this is how I know that I'm gonna be sidelined on other opportunities, right? So this is basically the filter I'm using. And then there, you know, there are other market phases like this or this or this, where it's just noise and where I'm just trying to be sideline waiting. For example, up here I don't buy, I just wait until it comes down into the Bollingers, then I'm gonna do something. So the Bollingers, they're not a holy grail or anything, they're just a filter to show me, okay, here I want to wait, right? I don't want to do anything, I just want to observe until the cheap prices come with my direction. And that's basically how I'm solving the problem of overtrading, because if you do it like that, you don't have that many signals. Sometimes even a whole day you don't have a signal, and that's fine. You just wait it out until there's a good opportunity. And I really wait until the price will, you know, come in the second and third, you know, until it's somewhere in there between, and where I'm gonna act, right? Either on 4 hour or sometimes even on 2 hours when I'm convinced there's a good level, like here. I'm pretty convinced here's a good level, so I can build up along here, for example, right? Of course, I'm using also confluence with structure sometimes, but basically this is how I'm filtering out the very good signals. So now let's delete all of that again. Here you go. All right, so then let's go to the next point again. So we are here full screen again, and now we're going to the top 2 reasons why you guys are still failing. Okay, so now the second most important reason why you are failing currently is dynamic risk to reward.
Reason 4. You are not using a dynamic risk to reward ratio.
Right, you guys don't know the power of dynamic risk to reward, or maybe you not using it. I heavily believe in dynamic risk to reward. What do I mean by that? I mean by that basically there's something called static risk to reward, right, and dynamic. So static risk to reward is basically if I would always do the same trade, right? If I would always say, okay, I'm a trader who is doing 1 to 5, you know, I want to get 5 times as much earnings as I have risk, you know, this is a very high risk to reward, right? 1 to 5. Why am I not believing in this kind of system of a static risk to reward, especially if the risk to reward is kind of on the higher end, right? We're not talking only about this 1 to 2 or something. We're not talking, we're talking maybe over that even. Okay, the reason why I don't believe in static risk to reward is the problem is if you go for a high risk to reward, like let's say you're going to a 1 to 5, right? You want to earn 5 times as much reward than you risk. Okay, now the problem is, and for this, let's go back to the charts actually, guys. So here you go. So the problem is, this is kind of akin to being like if you play soccer, if you're on the midfield line and you shoot on the goal always, right? What is the probability that you will hit the goal from the midfield line? It's very low, right? So this is the same as using a high, you know, risk to reward. So most of the time you're gonna miss the goal. So let's say extreme example, from 100 shots, you will miss 99 of them and only one of them will go in, right? So this is an extreme example. And now let me tell you why this is a big problem. The problem is, and let's draw it right here, maybe let's go down here. Okay, the problem is the following. What will happen to your equity curve if you play like this, right? Your equity curve or account balance curve is gonna be in a constant downtrend, right? Not even zigzag, that's not even true. It's just gonna be, let's say here's the first trade, it's a loss. There's the second trade, it's a loss. Third trade is a loss. Fourth trade is a loss. So it's just gonna be in this constant, drawdown. It's gonna be messing with your psychology a lot. You're gonna feel like the worst trader in your life, and then you heavily rely on this one high risk to reward trade that is gonna get you back at even, right? So what's the point of that? You're always gonna be stressed. You're gonna have drawdown. And what do most traders do in this kind of scenario? Actually, they do something very bad. What they do in this kind of environment, they actually even try to use the leverage, increase the leverage, which you should never do. Leverage is the worst thing, right? So they become impatient, right? Because they have a drawdown of 4 consecutive trades, which of course happens if you use a high risk to reward. It's bound to happen. Your win rate must go much lower because it's like shooting from the midfield line on the goal. You're gonna miss most of the times. And then they start, increasing the lot size and therefore increasing the leverage because they get impatient, right? And then you get this kind of equity curve, which even goes down more fast, right? So this is going to be your account, right? You're going to be losing, then increase the leverage and then you're done, right? Because you're going to even lose more and going to go steeper into drawdown. So this is very problematic, right? Of course, if you have a high risk to reward, the idea is kind of, okay, you're losing, but then this one big trade will propulse you all the way up again, right? This is kind of the idea. And in a good system, yes, it can work. I'm not saying this is completely not working. Like in a good system, it should be kind of like that, right? And then you can see these high risk to reward trades, they gonna get you back. So it's not impossible to work with this system, but I'm just saying for psychology, it's very, very hard and you're gonna be on the losing side the whole time because naturally your account balance curve is gonna be in drawdown all the time. And there's another big problem because let's say now you have been losing, and a lot of traders then change also their strategy, right? They're not doing the same system as well, right? And then they might even miss out on the winning trade because they're maybe not gonna take it anymore, or they're gonna tweak around with their strategy and then stay in the drawdown because of that. The other bad thing that can happen is that you are very reliant at this point, right, that you must make this a big gain to come back in profit. But let's say this big trade happens during a news, there you cannot really trade. Or let's say this big trade or this big move happened in the night when you were sleeping, or maybe you were not on the computer, so then you also missed it. What will happen after that? Well, you missed it and then you're gonna stay in drawdown because the next couple of trades will be losers again, right? So you're also very reliant to catch this big trade, and normally from my experience, the big trades, they happen during news. So with that being said, you are forced to trade during news as well with this kind of system. So this is why I'm not really believing in this static risk to reward, especially not if you do this kind of high risk to reward trading, right? So how can we overcome this problem? Well, basically, before I'm showing you that, I want to show you the other side of the coin. What is the other side of the coin? The other side is kind of this scalping system where you do very, very low risk to rewards, right? And there are a lot of traders who love scalping. They say this is the only thing how you can be profitable, so you need to do these very, very bad risk to rewards. So is that working or not? And the answer is that is also not really working, right? Maybe some people are profitable with this kind of system, but generally it's also very difficult to do. The reason is, let's say you do a very low risk to reward environment where you basically, you risk 10 times more than what you can gain, right? So you will gain a tenth of what you're risking. In that environment, you will always win because you have these very, very tight distances where you take profit is because you're kind of scalping, and you're always gonna win, right? So what will happen in this kind of scenario? Basically, your equity curve will go up, almost in a straight line because you're always winning, right? Maybe you have some losers in between that you cut. that is okay, and then you're gonna go up again, maybe you cut a loser here. So basically you have this kind of system where you're always winning, but then what will happen? The problem is there will be one kind of trade that you don't cut, and where the you know, this kind of bad risk to reward will play out, where you then you know, lose 10 times more than you were winning the whole time, and then this happens, right? You're gonna go all the way back to zero, right? Or maybe even into negative. So also this kind of trading system is not sustainable. This is the problem here. In my opinion, this kind of system is still better than the other one. Why is that? Because this is much better for psychology, and it's gonna give you a lot of consistency and stability, at least for a while, right? For a while, and especially if you get good at cutting the losses early before they're trending against you, for a while you can have a very good kind of equity curve with that normally always trends up like this, right? And you're gonna have this kind of equity curve that's kind of like a line, right? So this one is a very good system actually for psychology, and it's gonna make you consistent very fast, and you will think, oh, I'm the best trader or in the world because I have a win rate of 80% or something, right? So you'll think, oh, I'm so good, but the problem is what you don't see. Eventually you will get caught up in a trend that goes against you, and then this big loss will manifest and crash down the account. I'm sure you guys have experienced this. If you do scalping, you will be very good for a couple of weeks, and you will think, oh great, I'm the best trader in the world, and then this will happen, and at the end of a month or something, it's not sustainable, you will crash down to zero again, right? So that's the problem with the small risk to reward, right? Like a risk to reward that's like under 1-to-1, right? So now the question is, or becomes, how can we solve this problem, right? The answer is we can solve it in two ways. Okay guys, and also I want to say quickly about the high risk to reward, because you might think, okay Jonas, but so let's say I'm playing the high risk to reward, right? But I'm so good that I can avoid this drawdown, because actually I'm just sideline always and just catch this very one good trade, right? And I'm saying, yeah, this is how you can become profitable with a static system, because I'm not saying it's impossible, but I'm saying it's very hard, right? Because how will you do this, right? For example, think about the example again with the soccer, right? You're shooting from the midfield line 99%. You're shooting from the midfield line, 99 tries will miss, only one will hit. How will you filter out this one time that it will hit the goal, right? Very difficult to do, right? Of course, if you risk to rewards are lower, then it gets easier to filter out the ones that are hitting, and there you can try with a static risk to reward. I'm not saying it's impossible, but I'm saying it's very difficult, because with a high risk to reward system you need to be sideline, maybe the most of the time you need to be sideline, and you need to go in when this good one happens, right? And the problem is when you miss this good one, then automatically, because of the numbers, you will have again a drawdown period after that. So it's not easy at all. So now let's look at the answer. The answer is you need to play a dynamic risk to reward that is fitting your trading instrument, right? So now let's go back here. For example, this is Euro USD, right? So we know, and you need to know your trading instrument, right? But normally in the market it's like that most of the markets, they're basically sideline, they're basically ranging most of the time, right? They're just going up down, ranging like 70% of the time, and only 30% of the time they're trending, right? And even in a trend you always have pullbacks. So then this kind of game becomes to play the dynamic risk to reward. What do I mean? You need to kind of emulate what the market is doing. If it's ranging 70% of the time, well then 70% of the time you need to play a bad risk to reward, kind of like this 1-to-1 or even lower. Most of the time 1-to-1 is okay, but maybe it's going to be even 0.75 or maybe even 0.5. I would not go under 0.5, but I'm just saying most of the time you need to actually take your gains off the table, right? Because this is the problem what most traders do. They fall in love with their entry, they never take their gains off the table, then the market is just gonna reverse like it always does, and then you're at zero again and you didn't gain anything, or maybe you always take some small losses and they accumulate up, and then your account is also drawing down. So you can, for example, see this. Let's have a look here. Here we're actually trending pretty well, but you can see that most of the times you have these kind of pullbacks again, right? For example, here, right? There's a big pullback. So now let's say you bought it here, right? So here you can see it's better to take a gain maybe up here in the Bollingers again than to ride it all the way up, because anyway it came back down again, and anyway here you can get good entries again, right? So here and here maybe, and then ride it up again to the Bollingers, maybe get out somewhere here, and then again here you have anyway another opportunity to take it up again, right? So this just means that most of the times we should not be too crazy about our goal. Of course, now this moved all the way up here, but we only notice in hindsight, right? We don't notice when we're actually trading, and you can see it always came back again to anyway give us these kind of prices again. So we're playing more the dynamic risk to reward most of the times, the not so good risk to reward where we maybe go for a 1-to-1 or maybe even a 0.75, something like that, right? That's all okay, because it's gonna make our trading much more consistent, because it's a lot easier to hit a 0.5, 0.75 and a 1-to-1 than all the other things, right? And if, for example, guys, if we catch a, I don't know, 0.75 risk to reward, right? It's not that good, but if we catch it 3 times, our account is bigger, our psychology is better, and we can use these gains then for the bigger play where we want to do a bigger move, right? So most of the times we're not trying to go for the high risk to rewards, right? But of course, we know we need to be dynamic, because if we always play the bad risk to rewards, it's also not going to be sustainable. So sometimes we must try to go for the higher risk to reward. For example, maybe something in this area. So maybe, for example, like here, of course, this is hindsight. We don't know it before, but let's say like here, there it would have been better if we didn't sell here but just held it all the way up here, right, to get a very, very good bigger move, right? So this would be perfect, or maybe hold it until up here. We're never gonna get the perfect exit, guys, but at some point we also gotta shoot for the higher risk to reward, so we have a dynamic run, right? But important is, if we shoot for the higher one, we need to protect our SL at even very fast if we can do so, because we know most of the time the higher risk to reward stuff is not gonna work out. Like, you know, maybe 70% of time is going to fail, so that's why we need to protect it with SL. And also we need to finance these kind of high risk to reward trades with the bad risk to reward trades. This is why I'm saying they're working in tandem, and this is why you need to have a dynamic risk to reward. The higher risk to rewards, they should be financed with the low risk to reward trades, because the low risk to reward trades, you can get them pretty safely. The high risk to rewards, they're gonna lose most of the times, but if you finance them before, that's okay. Or if you use the SL at even as fast as you can, there's also a good measure, right? So basically this is how you combine low risk to reward with high risk to reward, right? Of course, this also, you should be careful. It doesn't mean we can be over trading, because this is not a green light to always trade, right? This is not what I mean. You still need to pick your very, very careful entries. I use the Bollinger Bands as filters, right? For example, like here, right? Eventually you get this kind of move, and then maybe you can take it off here, for example, right? At the last high point, right? So this would be a nice distance, right? And then it comes back down anyway, and then another day you can scale in again in this position, right? This is basically how we do it. So still our motto should be to be sideline most of the time, be sideline, be sideline, be sideline. Only go on the high quality signals, but then once you're in the trade, you need to look carefully, is this actually a high risk to reward play, or is this not a high risk to reward play? Is this going to be a low risk to reward play like 70% of the time, or is this going to be now the 30% of time where I'm holding? This you need to decide once the trade is moving, and then you need to look carefully how it's evolving, because it's constantly changing, right? But this is the most difficult thing to master in trading, in my opinion, to decide, is this a low risk to reward game, is this a high risk to reward game at the moment, or trade? How do I do it? There's a kind of hack what you can do it. You need to basically look in weekly, right? Or let's do it like that, because here's the Bollinger Band. In the weekly, I don't use Bollinger Bands, right? It's just for the smaller time frames. Basically, you need to go weekly and daily and figure out, we always want to predict the next candle. You need to figure out if this is going to be a momentum candle that's coming. If it's a momentum candle that's coming, great, then I want to hold it the whole week or hold it the whole day maybe, right? And there is going to be a high risk to reward play. But if you see in the daily or in the weekly, this is more sideways action, then what am I doing? I play the low risk to reward game, right? That's basically how I'm doing it, but still with strategy. Doesn't mean I can overtrade, right? Just because I'm using a dynamic risk reward doesn't mean I can overtrade and be in the market all the time. that's not the idea of it. You still need to filter out very good signals and only do something there, and the rest you're gonna be a sideline. All right, guys, this was a very important topic, talked about it a lot, and now let's go to the next point. Okay guys, so now we're at the final point, and this is the most important point. This is the reason why you're not profitable and why you're not getting there and why you're stuck, right? So let's look at it. This is leverage.
Reason 5. You are using leverage while trading.
Right? The leverage is evil, right? Leverage is the reason why you lose, because you need to think about you're trading against the broker, right? And the broker tries to debook you, of course, because most of the traders are losing. And why they're losing? Not because of their strategy, not because they cannot analyze the markets. It's nothing about that. They're losing because they are using leverage provided from the broker. Why do you think the broker wants to provide you the leverage? Because the more leverage you take, the less you can hold the trade, and the higher the chance that you need to get out of the trade, right? And the higher the chance that you will lose the trade. So with increased leverage, increased lot size, the higher the chance you will lose your trade, right? So, and the broker of course knows this, and the broker doesn't use any leverage, right? The broker can debook you. And what does that mean? That basically means you're trading against the broker, because the broker doesn't put you on the real market in that sense. It just creates an internal market and trades against you in the internal market. The broker is taking the other side, and the broker will be happily taking the other side, because if you do your Euro USD position long, the broker is doing it short maybe, and what will happen? The broker doesn't have any leverage. The broker has a lot of capital and can just hold the short position, and you did a long position, right? And you have this high leverage. It goes against you. It goes down, 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 down until your margin call is coming, and thank you very much, your money is now with the broker, right? And this is why you lose. So leverage is the most evil thing right here, and you need to learn how to control the leverage, right? So, and how did I incorporate this in my strategy? Let's go back to the charts. Okay, so basically what do we need to do? So we want to eliminate the leverage as much as possible. In a perfect world, we would not use any leverage when we're trading. In a perfect world, we have an account of 1 million and we don't need any leverage, right? And we can live off that, right? So, but that's not the perfect world, right? The unfortunately circumstance is that we need to use the leverage because our account is too small to make any sustainable gains to live from it, right? So that's why we need to use the leverage, right? And the leverage is nothing else as borrowed money from the broker, right? So with that being said, we need to find a system that balances this problem out, right? Where yes, we use a little bit of leverage, but never too much, but still enough leverage or still enough lot size that we can kind of have enough big gain where we can maybe live from trading without endangering the account, right? And of course the best route to go is actually in prop trading, because there you can trade higher lot sizes because the account is higher, and I would recommend to go that route actually. But this system I'm showing you, you can use this in private as well. I'm trading private and prop trading, and I'm using this for both accounts, right? So basically, what am I doing to control the leverage? The first step I'm doing, I'm going out to the monthly chart. So let's go here. So this is Euro USD on a monthly, and this can be used for any asset, right? I'm just showing always Euro USD because this is what I'm mainly trading, but I'm trading also many other things. So on the monthly chart, I don't use this for any analysis. I'm not using this for the bigger time frame buys because this I'm doing on the weekly. I totally don't look what is happening on the monthly chart. It doesn't matter. You can even think it like that. Just don't look at the candles. It doesn't matter. But what am I looking here in the weekly, on the monthly? I'm looking at average to range, right? Because this helps me with controlling the leverage a lot. So now we can see this is the average to range. We can see currently it's at 330 pips, right? What does that mean? That means each candle here on average, of course, sometimes it's higher, sometimes it's lower. And on average, each candle has a size on the monthly of 330 pips. So each month the Euro USD on average is moving 330 pips down or up, right? So, and that helps me a lot because I know now what is the monthly volatility. So so this helps me to understand how dangerous is this market and how should I control my leverage. And normally what I do is then, okay, I know this can, in the worst case, it can move 330 pips. Very unlikely this will all happen in one day, but it's not completely off the table. This happened, for example, in the Ukraine war. Then it moved like a whole monthly candle in almost 1 day or 2 days, right? But normally this doesn't happen. And so what do? I'm, assigning my worst case, and this depends on your risk tolerance or what you're doing, right? Your worst case scenario. And what is a worst case? The worst case is understood as something where stop management fails, where computer is off, where the internet connection is out. The worst case needs to be basically this distance of the monthly candle minimum, right? You can even go higher if you want to be more safe, but minimum, the worst case, you need to be able to sustain 330 pips, and only after that your worst case basically manifests. So what does worst case mean? Depends on your risk tolerance, right? If you're maybe trading a prop account, the worst case can be a maximum daily loss limit, so that would be a minus of 5% if the market crashes 330 pips, a whole monthly candle, right? Or if you're trading a private account, this can maybe be 10% of your account, 20% of your account. This is the really worst case. Of course, this will never happen in one trade because we stop loss management and everything. But let's say if everything else fails, this is your worst case, right? And if you do it like that, that really scales down the lot size. You then can calculate the lot size from your worst case. What is 330 pips on an account where I want to lose 10%? What does that mean? And that really gives you a small lot size. And with this small lot size and the worst case in mind, you already know what is the worst thing that can possibly happen. That improves your psychology a lot. And with the small, and it gives you a small lot size where you can trade peacefully, right? And where the account will not be endangered. So basically, this is how I'm using the ATR, and this is basically how I'm controlling the leverage and find a good balance on, okay, the lot size needs to be small enough so I'm not in danger, but still a little bit big enough so I can make some gains, right? So this is how I'm controlling the leverage. Good, guys, now let's go back here. With that being said, that was it from the video. Hope you could take something away, and I catch you next one. Peace. Bye bye.